So I was saying that the macroeconomic winds are blowing, and if you're an investor, you just have to decide how you're going to deal with it. And I think one choice is be caught up in the maelstrom and attempt to trade your way out of it by slavish devotion to the news of the day and attempting to predict what the central bank will do, and then try to figure out whether or not this is a good entry point or not a good entry point. And that's a recipe for anxiety, especially trying to pick the bottom and pick the top. And that's hard. A rational strategy is dollar cost averaging into scarce, desirable assets that, someone that's more affluent and more informed than you will want to buy from you in a decade. So if I was trying to come up with a plan to manage through the chaos, like I don't know that I could time the market. I think that I would just kind of dollar cost average my cash flows into a portfolio of property that was scarce, that was desirable, that would hold its value. And with the caveat that I need to be able to afford to maintain it. So if I could buy high quality property that I can afford to maintain for a decade, then as cash flows arrive, I would just allocate accordingly. And if you like Bitcoin, then Bitcoin, just dollar cost averaging into Bitcoin is a similar thing to that and rational. I think a useful chart is the 4-year moving average chart. I think if you look at the 4-year simple moving average of Bitcoin, it kind of reflects something synonymous to the book value of the network, because for 1,458 days, that number reflects the trading volume or the trading price of Bitcoin. So it's traded billions of dollars a day, 1,458 times. And so by the time you calculate that number, it typically lags the overall price, but it's gone up consistently for the history of the asset, for obvious reason. And if you're a dollar cost averager or a conservative Bitcoin investor, I think that you would look at that and think, yeah, for obvious reason, Bitcoin hasn't looked this cheap since March 20th of 2020. Like that was the last time when it touched this. And then you got to go back to like February of 2019. And then you got to go all the way back to 2015. So I think if you look at the near term, Bitcoin looks like a volatile risk asset in the near term. And if your time frame is near term, if it's a high frequency time frame, then you kind of got to trade Bitcoin like a high volatility risk asset, or an amped up risk asset. And if you're a low frequency, long-term trader, if you're buying it with expectation that a decade from now, it'll be worth more. Now it starts to look like a store of value, non-risk asset, because there's no management team, there's no product cycle, there's no employee base, there's no competitors. It's not a company. It's got no nexus. It's not in a country. It's not land. You can't produce more of it. It's a different thing. So depending upon whether or not you're short time frame or long time frame, you see it differently. And I think that in the near term, it's pretty clear it's a risk asset, and the Federal Reserve is going to control all the risk assets. And so when they squeeze the money supply, all those assets, the tech equities, the Bitcoin, they get hammered down. To your point, it seems reasonable at some point they'll lighten up. We're going into the midterms, right? So the things that are constraining risk assets right now are the war, foreign relations and the war in Ukraine and the Russian foreign policy and the monetary policy. And those could very well change. If they don't change, then all the risk assets will have a hard going for the next year to 2 years.